So, basically, what is borrowing interest?
Borrowing money is not free money. Borrowing interest is extra money. People pay for borrowing money from a bank. Banks charge borrowing interest on things like credit cards, loans, and mortgages. For example, someone borrows $1,000 from a bank. Before receiving the money, the person usually has to sign papers agreeing to pay the money back, with an extra percentage charged as interest. APR stands for annual percentage rate. APR is the percentage that shows how expensive borrowing money becomes over time. So instead of paying back only $1,000, the total amount might become $1,100, $1,200, or even more. That extra amount of money is called borrowing interest. Borrowing interest is basically the price of borrowing the bank's money. For example, someone buys a computer with a credit card. The bank pays for the computer first, and later the person has to pay the bank back. But the total amount paid back may become higher than the original price because borrowing interest keeps getting added over time, since that was part of the agreement the person signed. And if the money is not paid back on time, even more interest and extra fees may get added too. That's why many people eventually pay far more than the original price of the item. So basically, borrowing interest is extra money. People pay for borrowing money. Borrowed money always has a price.
So, basically, what is savings interest?
Savings interest is extra money the bank pays to people for keeping money in the bank. Banks sometimes pay savings interest on things like savings accounts. For example, someone puts $1,000 into a savings account. The bank keeps the money there, and over time the bank may slowly add extra money to the account. Before opening the account, the person usually signs papers that include a certain interest percentage, or APR. APR stands for annual percentage rate. APR is the percentage that shows how much money may slowly be added to the savings account over time. So instead of still having only the original $1,000 later, the total amount of money in the account may slowly become higher. That extra money added by the bank is called savings interest. Savings interest is basically money the bank pays for using the person's money for some time. And the longer the money stays in the account, the more savings interest may keep getting added. That's why some people use savings accounts to slowly grow their money over time. So basically, savings interest is extra money the bank pays people for keeping money in the bank.
So, basically, what is inflation?
Inflation means everyday things slowly become more expensive over time. For example, years ago, a loaf of bread might have cost $2. Milk maybe cost $3. Rent and restaurant meals were cheaper too. But little by little, the prices went up. Now that same bread may cost $4 or even more. That is inflation. Inflation means the same amount of money buys fewer things than before. For example, someone goes grocery shopping with $100. A few years ago, that $100 could fill the shopping cart. Today, the same $100 may only buy half as much food. The money is still $100, but it does not go as far anymore. Inflation affects almost everything: food, gas, electricity, housing, clothes, cars, and everyday bills. A small amount of inflation is normal in most countries, but when inflation becomes too high, life becomes harder because people must spend much more money just to afford normal everyday things. So, basically, inflation means prices slowly rise over time, and money slowly loses buying power.
So, basically, what causes inflation?
Inflation usually happens when everyday things become more expensive to make, move, or sell. For example, if gas prices go up, transportation becomes more expensive, so stores may raise the prices of food and products too. If workers need higher pay because life is more expensive, companies may raise prices again. And sometimes, if many people suddenly start buying a lot more things, prices can rise because demand becomes very high. Here's a simple example. Imagine a bakery. If flour, milk, electricity, and employee wages all become more expensive, the bakery may raise the price of bread from $3 to $4. That is inflation happening in real life. Sometimes inflation can also happen when a country prints too much money or when there are shortages of important products. For example, less oil, less food, or supply chain problems. Then prices across the economy can rise very quickly. Inflation means money slowly loses buying power because everyday prices keep going up. So basically, inflation happens when everyday prices start rising across the economy, and people need more money to buy the same things.
So, basically, why do governments print money?
Most modern countries can create new money through their central banking system. But governments and central banks usually do not create money for no reason. It often happens during difficult economic situations. For example, during recessions, financial crises, pandemics, or wars. If the economy becomes very weak, people may lose jobs, businesses may close, and banks may stop lending money. So central banks and governments sometimes try to increase the amount of money in the economy to help keep businesses, banks, and spending alive. For example, during COVID-19, many countries sent stimulus checks to citizens and created large economic support programs. The idea was simple. If people keep spending money, businesses may survive, workers may keep their jobs, and the economy may avoid collapsing. Historically, governments have also created large amounts of money during wars or major national emergencies. But there is also a danger. If too much new money enters the economy too quickly, while there are still not enough products, food, homes, or services available, prices can rise very fast. Economists sometimes describe this as too much money chasing too few products. That is one reason inflation can happen. And in extreme historical cases, some countries printed so much money that prices became completely unstable. So, basically, governments and central banks sometimes create money to help support the economy during difficult times. But if too much money is created too quickly, inflation and rising prices can become a serious risk.